QuickBooks Pro Desktop 2021. Forward contract, maturity transactions within QuickBooks. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our practice problem number 4, multiple currencies. We currently have the open windows open. You could open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we put together we're going to purchase equipment on account. On account, we're going to pay off the payable in the future, and we're going to be paying it in foreign currency. In order to mitigate the risk of that foreign currency transaction, we put a forward contract on the books. We then did adjusting entries at the end of the year, and now are thinking about the maturity dates, in this case specifically for the forward contract. Let's consider where we are at this point by going to the reports dropdown, company and financial. Take a look at that balance sheet standard, the standard balance sheet. Customizing the reports up top, changing the dates from 01/01/21 to 12/31/21, and then we'll say okay. So we're looking here, we put this on the books, the machinery and the equipment at the $60,000, and then the other side of that was going to be a payable that was in foreign currency. And that payable resulted in risk due to the fact that there could be changes in the currency. Therefore, we put a forward contract on the books in order to mitigate that. That's what we're going to be concentrating in on now. The forward contract results in both a receivable and a payable. In this case, the payable in dollars, so that's going to be a more easy kind of transaction, no foreign currency issues with it. The receivable is going to be the more complex one because it does have foreign currency issues with it, in that we're going to be paid not in dollars, but in the foreign currency, in our case, the Australian dollar as opposed to the US dollar. So if I double click on this, this is what we have thus far. We had put the forward contract on the books at the beginning using the forward rate at that point in time. We then did an adjustment as of the end of the year in order to make it correct as of the cutoff date. Now we're thinking about the maturity transaction. First, let's consider what that would look like in Excel. If I go on over to Excel, we did this last time. And note, before we did the transactions we're going to do here, we did an adjustment up top to the receivable here with this transaction. Now, this transaction is not one we're going to put in our system. We're going to do it a little bit differently with an adjusting entry and a reversing entry. Here, what we did is we adjusted it to the correct amount of the receivable as of this point in time, and then did the adjusting entry for it. We're going to kind of combine those adjustments together in a little bit different way by doing an adjusting entry that we saw up top. We did the adjusting entries in year 1, and then we're going to reverse those entries, and then the system will basically record a transaction. Let's go back to QuickBooks. If I go back to the home page, the system will automatically, when I hit the receive payment, it will record a transaction that's going to record the difference between the 2 points in time in terms of the 2 rates at that point. And the adjusting and reversing entry will then make it so we have the proper breakout between the prior year and the current year. So we're going to twist that up a little bit. And so you want to just, put your focus in on that. We'll see that as we go. We'll do this entry first to close out the receivable first. And then we're going to go back in and we'll check out the reversing entries, because I think it'll be more clear that we'll see it be doubled up, and then we'll enter the reversing entry. Okay, so let's first mirror this one. This one is going to be kind of the easy side, where we're saying this is the non-foreign currency transaction where we're going to be paying cash and then we're going to pay off the payable. Let's do that one first, so we're kind of in somewhat of order here. So if I go back to our sheet, the balance sheet, that would be looking into this item down here, the payable for the exchange broker. So we'll pay that one off. And if I double click on that, notice it just went on the books when we started the forward contract, $60,900. Nothing has changed since that point in time because it's in cash and there is no foreign currency kind of adjustments for it. It's a bill, so we're going to go ahead and pay the bill, cash going down, this account then going down. Go into the home page, we're going to pay that bill. When the bill was entered here, we're going to pay it on this side. So we'll pay the bill, pay bill. And then we're going to say that we want it for the payable account, but we want this exchange broker payable account that's in US dollars. So I want that one. There it is, checking that item off. So that's the one we want. And we're going to put it in place as of the date of 3/31 and 22. So 03/31/22. So that looks good. I'm going to assign a check number for it. It's coming out of our normal checking account. What will this do? Well, it's going to be kind of like a check or a decreased form, a form that decreases the checking account. Therefore, cash then going down. Other side going to the accounts payable, closing out this particular payable. So let's go ahead and say pay the bill, and we'll assign the check number A3 or something. And then I'm going to say okay, and that's okay, I believe. And so I'm going to close this back out. Let's go back to the old balance sheet here. And then if we go up top to change the date, so I'm going to change this to 22 now. So the checking account goes down, double clicking on the checking account. If I bring this back to 01 to 2, there's going to be the transaction decrease in the checking account. The other side went into the payable, which has now disappeared because it's at 0. Let's take a look at the trial balance, where it's a little bit easier to see it because the zeros should be present there. Reports drop down, accounting taxes, trial balance, trustee TB. And then we're going to say 01/01/22 to 12/31/22. And so there we have our transaction there. And we're looking at this item now at 0. Double clicking on it, we see that 60,900 bill, bringing it then to 0. Closing that back out, let's go back to the balance sheet to consider the other side, which is a little bit more confusing, which is going to be the receivable side of things. If I look at Excel now we're looking at this side. So we're taking basically the receivable off the books. It'll look a little bit different, however, because we're not going to do this adjustment for it first and then take the receivable off. We're gonna let the QuickBooks take the change and then do a reversing entry. So it'll be a little bit different of a transaction, but we're working with this item now, and in order to do so, we want to make sure that we have the current exchange rate, which is now the spot rate of 0.602. So when we're looking at the forward contract, we were using the forward rate, speculating up until this point, the spot in time. Now we're at this point in time, and we're jumping back over to the spot rate because we're at this point in time. So we're going to go back on over, and I can then go to my lists drop down and go to the currency lists. So, and then we can just, now if this was in real time, we could then just go to the activities drop down, rise up, and we could say download the latest rates. This is a practice problem, so we're going to double click and put it in manually into the Australian dollar. Now this is the correct rate, so if I was to download the rates, it would be the spot rate. This is not a forward rate at this point. So we could just simply download it if we were in real time. So this is 03/31/2. So 03/31/22. And this is going to be then 0.602. So 0.602. And then we're going to say, let me just check that one more time. Yeah, that's right. And then I'm going to say okay. I like to say okay. And then I'm going to say, and then I'm going to close this out. And then we're going to go to the home page. And so we enter the invoice. So now we can say we can receive the payment now. Now we can receive the payment. So let's do that. Receiving the payment. And we're going to be receiving it. Now, when we receive the payment, that means the accounts payable is going to go down. And the other side is going to go into some kind of cash account. In our case, typically undeposited funds, unless we change it to go into some other account. But I'm going to go into undeposited funds here. Drop down, we want the Australian receivable. That's the one. We're going to pick up our customer. That's going to be the exchange broker. That's the one we want. And then I'm just going to check it off. When I do, it'll populate the amount up there automatically for us. So check it off. And then I'm going to say, okay, yeah. Puts it up there automatically, just like I said it would. And there we have it. So now we got this. That looks good. So this means we're going to receive the Australian dollars, which is the 100,000 Australian dollars. And then if we use this exchange rate, the 0.602, which we just input into the exchange rate area, then it's going to be the 60,200 in US dollars. If I go back on over to here, that's going to match what we have in our Excel worksheet. So let's just recap what this is going to do. It's going to be decreasing the receivable for the amount that receivable was on the books for, which is a different amount than this because we had a different exchange rate. We had the exchange rate when we first put it on the books, not changing it for the adjusted rate. They're looking at the first exchange rate. And then we're going to have the undeposited funds, which goes up by the 60,200, which is the new exchange rate. The difference between the first and new exchange rate then is going to be recorded in a gain or loss, meaning the entire difference is going to be recorded in the gain or loss. That's going to cause us kind of a problem because we did an adjusting entry for part of that difference. And so the way we'll account for that is with an adjusting and reversing entry. All right, let's check it out. I'm going to save it. It'll all make sense. promise. And then we're going to close this out. And then we're going to go to the balance sheet. And then in the balance sheet, we're left with this $300. So the $300 is still there. Why? If I double click on that and I change the date at the beginning so we can see the detail, is going to be, we put it off, we took it off the books at the same amount that we basically put it on the books for, the $60,900. And then it put the difference between the exchange rates into the gain or loss account. However, we had already adjusted for $300 of it. Therefore, that $300 is basically doubled up. So we're going to have to reverse the $300. So $300, and that's what we'll do with the reversing entry. Then the other side of this is going into undeposited funds. So undeposited funds has now increased by that $60,200. And then the difference is going to go to the income statement. Reports drop down, company and financial, P&L, profit and loss, income statement from 01/01/22 to 12/31/22. And there's our 700 on the income statement. If I double click on that 700, if I go back on over to Excel, this 700 represents the gain and loss on the receivable. Let's see if we can do it this way, where we had the receivable gain and loss is here, and then here. The difference between those two is that 700. So it's recording the whole difference from the receivable that we have at one time, and we already recorded 300 of it. What the problem is, what we need is for 300 of it, the gain of 300 to be recorded in the prior year, and then 1,000 loss to be recorded in the current year. What it did is record the full difference of 700 in the current year. So if I go back to the prior year, 21, then we could see what happened here is when we did the adjusting entry, we had the $300, the adjusting. It gets a little confusing because this $1,000 is is for the other payable. The 300 applies to this item, the receivable, not the payable. We can see it in the split here. So the receivable, and that was correct. So this is now correct as of the cutoff, but then it recorded the full amount of 700. So what we need to do is a reversing entry. When I reverse that 300, it will then take that 700 up to 1,000. So we'll do a standard adjusting and then reversing process, and then we can just record, just as we did, the invoice and then the receivable, and it'll all play out. Meaning, on the bookkeeping side of things, they don't have to do anything funny with our adjusting entry, because we'll reverse it out, and all we have to do is just basically go invoice, then the receive payment. I don't need to do anything funny with this interim adjusting entry because we're going to put it in place and then reverse it, making the bookkeeping process easy. We have one last step here, and that's going to be to record the deposit taking it out of undeposited funds, putting it into the checking account. So I'm going to go ahead and record the deposit, and I'm going to check this one off. That's the one we want, and okay. Now I'm going to put it into not the US checking account, but I'm going to put it into the Australian checking account, which I do not have set up at this point. So I'm going to add a new checking account. Let's add a new one and say we want a bank account, and I'm going to call it checking, and then we want this drop down for the Australian dollar, the AUD, Australian dollar. And so there we have it. So I'm going to say save it, close it, and then okay. So there it is. That looks good. Looks good. So I'm going to say save it and close it, and then we'll check it out. Yes. And then let's check it out by going to the balance sheet, and the undeposited funds has now disappeared because it's zero. And then in the Australian checking account, we have that $60,200 that has been put in place on the current spot rate, which represents the 100,000 actual foreign currency dollars, Australian dollars, that we have, with the US equivalent being the 60,200 given the current day exchange rate. If we take a look at the trial balance now, then this is where we stand at this point in time. We could see the undeposited funds here, of course, having been increased and then decreased. And so that's where we stand at this time. So next couple presentations, we need to do the reversing entries, and we need to take care of this this payable as well. We got to take care of that payable. The reversing entry will make that go down to zero, and we need to apply out the proper amounts to the gains and losses to the proper years, year 1 and year 2.